Hey everyone, and welcome. Today, we are going to pull back the curtain on a fascinating real-world retirement strategy. It was developed by a retired university teacher named Lynn, and she's come up with a system to not just survive a market crash, but to actually thrive in one. So let's get right into it.
I mean, this is it, right? This is the one question that keeps almost every single soon-to-be retiree up at night. You've worked your whole life, you've saved up this nest egg, but what on earth happens if the market decides to take a nosedive the day after you clock out for the last time? Well, Lynn's strategy offers a really powerful answer.
You see, for someone who just started retirement, the biggest danger isn't just a crash. It's something a little more subtle, a hidden risk that can do some serious, long-term damage right when you're most vulnerable.
And that risk has a name. It's called sequence of returns risk. Now that sounds complicated, but the idea is actually pretty simple. It's all about timing. When you start pulling money from your portfolio to pay your bills, it matters a ton whether the market is up or down. If you're forced to sell your investments when they're down, you have to sell way more of them just to get the same amount of cash, and that can permanently cripple your portfolio's ability to ever bounce back.
And here you can see that problem playing out perfectly. The lucky retiree gets a nice tailwind. The unlucky one, they're hit by a hurricane. They're forced to sell low, which locks in their losses and shrinks the amount of money they have left to grow. So even if the market comes roaring back a few years later, their portfolio might never, ever recover from that early damage. This right here is the exact problem Lynn wanted to solve.
Okay, so now let's pop the hood and get into the actual mechanics of Lynn's strategy. It all starts with a very, well, let's just say an unconventional portfolio, one that's built from the ground up for maximum resilience.
All right, take a look at this allocation. The portfolio starts with a beta of about 0.9. Now, beta is just a fancy way of measuring how much your portfolio swings compared to the market. A beta of 1 means it moves with the market, so 0.9 is slightly more conservative. But let's be honest, that's not what jumps out at you, is it? It's that massive 40% cash position. And no, that is not a temporary thing. That cash is the absolute bedrock of this entire system.
And the key here is how this cash is treated. This is not investment money waiting on the sidelines to buy the dip. Think of it as a financial and psychological safety net, a giant liquidity moat that's deep enough to make sure she never, ever has to sell her growth assets just because she needs cash.
This is Lynn's core philosophy right here. Cash is life, not an investment asset. With enough cash to cover 2 decades of expenses, she has the confidence to ride out any storm. And here's the absolute game changer. Her income in retirement doesn't come from selling a single share. It comes from borrowing against her portfolio. This one move completely sidesteps that whole sequence of returns risk we were just talking about. It's brilliant.
So that brings us to the most innovative part of the whole strategy. How does Lynn actively manage her portfolio's risk and return without ever touching that sacred cash reserve? Well, this is where the real magic happens.
So instead of using her precious cash to buy stocks when they're down, she does something different. She swaps some of her core holdings in an ETF that tracks the NASDAQ 100 for a more aggressive 3x leveraged version. This move dials up her exposure to the market at the exact moment when assets are on sale. And all the while, that huge pile of cash just sits there, completely untouched.
And this just makes the difference crystal clear. The traditional way of doing things forces you to spend your dry powder, to chip away at your safety net. Lynn's method? It keeps her cash totally insulated from any market timing decisions. Her safety net stays safe, period. Now, the system works both ways, which is what makes it so smart. As the market bounces back, that leveraged position supercharges her returns, and the portfolio's overall risk, its beta, starts to climb. Once it hits her predefined limit of 1.4, she systematically swaps back, locking in those profits and lowering her risk. It's a completely disciplined, rules-based approach, no emotion involved. Okay, so the theory sounds really elegant, right? But the big question is, how does this thing actually perform in the wild? Let's take a look at the numbers that Lynn shared.
The results are, well, they're pretty impressive. Year to date, her strategy pulled in a 27% return. That's compared to just 15% if she had simply held the index. That extra 12% is what we call alpha. It's the outperformance she generated purely from her dynamic risk adjustments.
So this is the playground her portfolio lives in. Its risk level can go as low as 0.7 during a crash, making it even safer than the overall market. But then it can ramp all the way up to 1.4 on the rebound to catch those amplified gains. The whole thing is controlled by a clear set of rules, which takes fear and greed completely out of the equation.
For Lynn, this was never just about the financial numbers. It was about a huge psychological shift. She said the moment she started borrowing for her living expenses, instead of selling her assets, the fear of running out of money just evaporated. It was replaced by a feeling of real, genuine financial security.
So what are the big principles we can pull from this really powerful, real-world strategy? Let's boil it down to the 4 pillars that make this entire thing work.
Let's run through them real quick. Pillar 1, stop the sequence risk dead in its tracks by borrowing for income, not selling. Pillar 2, treat that huge cash pile as a sacred safety net, not as ammo for investing. Pillar 3, use asset swaps to dial your risk up and down without ever touching that cash. And finally, Pillar 4, have a system with clear rules to keep your own emotions from wrecking the plan. Put them all together, and you get a system that's both incredibly resilient and powerfully opportunistic.
And that's really the big idea I want to leave you with. Lynn's success doesn't come from some magical ability to predict what the market will do next. It comes from building a robust system. A system that gives her the freedom to stay invested and let her money compound no matter what Wall Street decides to throw at her.